This should be good news for markets, right? It's, at the fundamental level, a better than expected economy, not just better than economists had expected, but also better than policymakers had expected. And the fact that Beijing is, focusing on debt risks, financial risks after what we saw in the US and Europe, this should be good news for markets. But what we're seeing is actually markets are taking a very kind of glass half empty mentality. And every time we see data that beats estimates, actually markets fall. The focus is on, what is actually wrong in this report. Even when exports are stronger than estimated, people kind of take a negative read on it. And what's really kind of a cloud over Chinese markets right now is geopolitics, and that's really ramping up. I mean, the noise around that has really accelerated and is likely to, that's not going away anytime soon. We're just getting into the U.S. election cycle. Let's not forget the U.S. election is next year. And really, it's the one thing, being kind of a China hawk is the one thing that unites Republicans and Democrats. So that's really kind of, keeping investors away from Chinese equities, especially those offshore. I mean, we saw UBP yesterday was on the show saying that they cut their allocation from overweight to neutral. They're saying that this kind of noise is making it increasingly difficult to have an outright overweight stance on China, even though the kind of fundamental reasons to own Chinese equities and Chinese assets are all there. So you have this kind of dichotomy between what the picture on the ground is telling you and what markets are doing, and it's so sentiment driven right now.